Right. Am I live yet? Yeah. Morning. We were a little worried today because we weren't sure from the reservations whether we could handle everybody, but it looks to me like there may be a couple seats left up there. But I think next year we're going to have to find a different spot because it looks to me like we're up about 600 this year from last year, and to be on the safe side, we will seek out a larger spot. Now, there are certain implications to that because, as some of the more experienced of you know, a few years ago we were holding this meeting at the Joslin Museum, which is a temple of culture, and we've now, of course, moved to an old vaudeville theater, and the only place in town that can hold us next year, I think, is the Exarban Coliseum, where they have Keno and racetracks. So we are sliding down the cultural chain just as Charlie predicted years ago. He saw all this coming. Charlie, I have some rather distressing news to report. There are always a few people that vote against everyone on the slate for directors, and there maybe a dozen or so people do that. And then there are others that single shot it, and they pick out people to vote against. And this will come as news to Charlie. I haven't told him yet, but he is the only one among our candidates for directors that received no negative votes this year. Hold it. No need to applaud. I tell you, when you lose out the title of Miss Congeniality to Charlie, you know you're in trouble with it. Now, I'd like to tell you a little bit how we'll run this. We will have the business meeting in a hurry with the cooperation of all of you, and then we will introduce our managers who are here, and then we will have a Q&A period. We will run that until 12 o'clock, at which point we'll break. And then at 12:15, if the hardcore want to stick around, we will have another hour or so until about 1:15 of questions. So you're free to leave, of course, any time. And I've pointed out in the past that it's much better form if you leave while Charlie is talking rather than when I'm talking. But feel free any time. But if you're panicked and you're worried about being conspicuous by leaving, you will be able to leave at noon. We will have buses out front that will take you to the hotels or the airport or to any place in town in which we have a commercial interest, and we encourage you staying around on that basis. Let's get the business of the meeting out of the way, and then we can get on to more interesting things.
My name is Michael Mullen from Omaha. Would you comment on the use of derivatives? I noticed Dell Computer stock was off 2.5 points Friday with the loss in derivatives.
The question is about derivatives. We have in this room the author of the best thing you can read on that. There was an article in Fortune about a month ago or so by Carol Loomis on derivatives, and far and away is the best article that's been written. We also have some people in the room that do business in derivatives from Solomon, and it's a very broad subject. As we said last year, I think someone asked what might be the big financial story of the 90s, and we said we obviously don't know, but that if we had to pick a topic, that it could well be derivatives, because they lend themselves to the use of unusual amounts of leverage, and they're sometimes not completely understood by the people involved. And anytime you combine ignorance and borrowed money, you can get some pretty interesting consequences, and particularly when the numbers get big. And you've seen that, of course, recently with the recent Procter & Gamble announcement. Now, I don't know the details of the P&G derivatives, but I understand, at least from that what started out as interest rate swaps ended up with P&G writing puts on large quantities of U.S. and I think one other country's bonds. And anytime you go from selling soap to writing puts on bonds, you've made a big jump. And the ability to borrow enormous amounts of money, combined with the chance to get either very rich or very poor very quickly, has historically been a recipe for trouble at some point. And derivatives are not going to go away. They serve useful purposes and all of that, but I'm just saying that it has that potential. And we've seen a little bit of that. I can't think of anything that we've done that would... Do you think of anything we do that approaches derivatives, Shirley? Directly?
No.
No. I may have to cut him off if he talks too long. Is there anything you would like to add to your already extensive remarks?
No.
Okay. In that case, we'll go to zone 2.
My name is Hugh Stevenson. I'm a shareholder from Atlanta. My question involves the company's investment in the stock of Cap Cities. It's been my understanding in the past that that was regarded as one of the 4, quote-unquote, permanent holdings of the company. So I was a little bit confused by the disposition of 1 million shares. Could you clarify that? Was my previous understanding incorrect, or has there been some change, or is there a third possibility?
Well, we have classified the Washington Post Company and Cap Cities and Geico and Coke in the category of permanent holdings. But in the case of 3 of those 4, the Washington Post Company, I don't know, maybe 7 or 8 years ago, Geico some years back, and now Cap Cities, we have participated in tenders where the company has repurchased shares. Now, the first 2, the Post and Geico, we participated proportionally. That was not feasible and incidentally not as attractive tax-wise anymore. The 1968 Tax Act changed the desirability of proportional redemptions of shares from our standpoint. That point has been missed by a lot of journalists in commenting on it, but it just so happens that the commentary that has been written has been obsolete in some cases by 6 or 7 years. But we did participate in the Cap Cities tender offer just as we did in the Post and Geico. We still are by far the largest shareholder of Cap Cities. We think it's a superbly run operation in a business that looks a little tougher than it did 15 years ago, but looks a little bit better than it did 15 months ago. Charlie, you have anything on?
No.
He's thinking it over now, though, before. Zone 3.
Good morning. My name's Howard Bascom. I'm from Kansas City, and I've got a theoretical value question for you. If you were to buy a business and you bought it at its intrinsic value, what's the minimum after-tax free cash flow yield you'd need to get?
Well, your question is if we were buying all of a business and we were buying it at what we thought was intrinsic value, what was the minimum?
Correct.
Present earning power, or what the minimum discount rate of future streams?
No, what's the minimum current after-tax free cash flow yield you'd need to get?
We could conceivably buy a business. I don't think we would be likely to, but we could conceivably buy a business that had no current after-tax cash flow. But we would have to think it had a tremendous future. But we would not find, obviously, the current figures, particularly in the kind of businesses we buy, tend to be representative, we think, of what's going to happen in the future. But that would not necessarily have to be the case. You can argue, for example, in buying stock at a time when it was losing significant money. We didn't expect it to continue to lose significant money, but if we think if we think the present value of the future earning power is attractive enough compared to the purchase price, we would not be overwhelmed by what the first year's figure would be. Charlie, you want to add to that?
Yeah, well, we don't care what we report in the first year or two of after buying anything.
Well, I would say that in a world of 7% long-term bond rates, that we would certainly want to think we were discounting future after-tax streams of cash at least a 10% rate. But that will depend on the certainty we feel about the business. The more certain that we feel about a business, the closer we're willing to play it. We have to feel pretty certain about any business before we're even interested at all. But there's still degrees of certainty. And if we thought we were getting a stream of cash over the next 30 years that we felt extremely certain about, we would use a discount rate that would be somewhat less than if it was one where we thought we might get some surprises in 5 or 10 years. The possibility existed. Charlie?
Nothing to add.
Okay. Zone 4.
Morris Spence from Omaha, Nebraska. You've made comments on several occasions about the intrinsic business value of the insurance operations. And in this year's report, you state that the insurance business possesses an intrinsic value that exceeds book value by a large amount, larger, in fact, than is the case at any other Berkshire business. I was wondering if you would explain in greater detail why you believe that to be true.
Well, it's very hard to quantify, as we've said many times in the report, but I think that it's clear that even taking fairly pessimistic assumptions, that the excess of intrinsic value over carrying value is higher by some margin for the insurance business. And I think that the table in the report that shows you what our cost of float has been over the years and also what the trend of float has been over the years would, unless you thought that table had no validity for the future, I think that table would tend to point you in the direction of saying the insurance business does have a very significant excess of intrinsic value over carrying value. Very hard number to put something on, and you don't want to extrapolate that table out, but I think that table shows that we started with maybe 20 million of float and that we're up to something close to 3 billion of float, and that float has come to us at a cost that's extremely attractive on average over the years. And just to pick an example, last year when we actually had an underwriting profit, the value of that float was something over $200 million. And that figure was a lot bigger than it was 10 years ago or 20 years ago. So that is a stream. Last year was unusually favorable, but that's a very significant stream of earnings, and it's one we feel we have reasonably good prospects in. So we feel very good about the insurance business. Okay, Zone 5.
Yeah, my name is Cy Rademacher from Omaha. Is there any point at which your stock would rise to the point where you might split the stock?
Surprise, surprise. I think I'll let Charlie answer that this year. He's so popular with the shareholders that I can afford to let him take the tough questions.
I think the answer is no. I think the idea of carving ownerships in an enterprise into little tiny $20 pieces is almost insane. I mean, it's quite inefficient to service a $20 account, and I don't see why there shouldn't be a minimum as a condition of joining some enterprise. Certainly, we'd all feel that way in a private enterprise.
Yeah, we would not carve it up in $20 units. We find it very, it's interesting because every company finds a way to fill up its common shareholder list, and you can start with the A's and work through the Z's, and every company in the New York Stock Exchange, one way or another, has attracted some constituency of shareholders. And frankly, we can't imagine a better constituency than is in this room. I mean, we don't think we can improve on this group, and we followed certain policies that we think attracted certain types of shareholders and actually pushed away others, and that is part of our eugenics program here at Berkshire.
Yeah, just look around this room, and as you mingle with one another, this is a very outstanding group of people, and why would anybody want a different kind of a group?
Yeah, if we follow some policies that cause a whole bunch of people to buy Berkshire for the wrong reason, the only way they can buy it is to replace somebody in this room or in this larger metaphorical room of shareholders that we have. So someone in one of these seats gets up and somebody else walks in. The question is, do we have a better audience? I don't think so. So I think Charlie said it very well. Zone 6.
Mr. Buffett, my name is Rob Naw. I'm from Omaha, Nebraska. My question is, given the recent announcement of Midwest Express and their nonstop jet service between the East and West Coasts, will this cut down on your use of the indefensible? And will you use more commercial air travel?
This is a question planted by Charlie. I think you should know. I take it to the drugstore at the moment, and it's just a question when I start sleeping in it at the hangar. Nothing will cut back on the indefensible. It's being painted right now, but I told him to make it last a long time. Charlie, though, was pointing out the merits of other kinds of transportation last night at the meeting of our managers. He might want to repeat those here.
Well, I just pointed out that the back of the plane arrived at the same time as the front of the plane, invariably.
He's even more of an authority on buses, incidentally, if anybody has any. Zone 7.
Mr. Buffett, my name's Alan Maxwell from Omaha. I've got 2 questions. What is your next goal in life now that you're the richest man in the country?
That's easy. It's to be the oldest man in the country.
Secondly, you talk about good management with corporations and that you try and buy companies with good management. I feel that I have about as much chance of meeting good managers other than yourself as I do bringing Richard Nixon back to life. How do I, as an average investor, find out what good management is?
Well, I think you judge management by 2 yardsticks. One is how well they run the business, and I think you can learn a lot about that by reading about both what they've accomplished and what their competitors have accomplished, and seeing how they have allocated capital over time. You have to have some understanding of the hand they were dealt when they themselves got a chance to play the hand. But if you understand something about the business they're in, and you can't understand it in every business, but you can find industries or companies where you can't understand it, then you simply want to look at how well they have been doing in playing the hand essentially that's been dealt with them. And then the second thing you want to figure out is how well that they treat their owners. And I think you can get a handle on that oftentimes. A lot of times you can't. I mean, there are many companies that obviously fall in somewhere in that 20th to 80th percentile, and it's a little hard to pick out where they do fall. But I think you can usually figure out. I mean, it's not hard to figure out that, say, Bill Gates or Tom Murphy or Don Keogh or people like that are really outstanding managers, and it's hard to figure out who they're working for. And I could give you some cases on the other end of the spectrum too. It's interesting how often the ones that, in my view, are the poorer managers also turn out to be the ones that really don't think that much about the shareholders, too. The two often go hand in hand. But I think reading of reports, reading of competitors' reports, I think you'll get a fix on that in some cases. You don't have to, you don't have to make 100 correct judgments in this business or 50 correct judgments. You only have to make a few. And that's all we try to do. And generally speaking, the conclusions I've come to about managers have really come about the same way you could make yours. I mean, they've come about by reading reports rather than any intimate personal knowledge or knowing them personally at all. Read the proxy statements, see what they think of, see how they treat themselves versus how they treat the shareholders, and look at what they have accomplished considering what the hand was that they were dealt when they took over, compared to what is going on in the industry. And I think you can figure it out sometimes. You don't have to figure it out very often. Charlie?
Nothing to add.
No. Okay, we're back to Zone 1.
Hi there. My name is Lee. I'm from Palo Alto, California. In meeting Ajit Jain, I've been very impressed over the years. I think I even met his parents once. They came from India. Please comment on your deepest impressions of his personality and managerial skills, and also how you go about exactly keeping somebody with such fine skills within the fold. He might go to Walt Disney someday and pull down $200 million.
Well, if he gets offered $200 million, we may not compete too vigorously at that level. We basically try to run a business so that Charlie and I have two jobs. We have to identify and keep good managers interested after we figured out who they are, and that often is a little different here because I would say a majority of our managers are financially independent, so that they don't go to work because they are worried about putting kids through school or putting food on the table. So they have to have some reason to go to work aside from that. They have to be treated fairly in terms of compensation, but they also have to figure it is better than playing golf every day or whatever it may be. And so that's one of the jobs we have, and we basically attack that the same way. We look at what they do the same way we look at what we do. We've got a wonderful group of shareholders. Before I ran this, I had a partnership. I had a great group of partners, and essentially I like to be left alone to do what I did. I like to be judged on the scorecard at the end of the year rather than on every stroke, and not second-guessed in a way that was inappropriate. I like to have people who understood the environment in which I was operating. And so the important thing we do with managers generally is to find the 400 hitters and then not tell them how to swing, as I put in the report. Second thing we do is allocate capital. And aside from that, we play bridge. It's pretty much what happens at Berkshire. So with any of the managers you might name here, we try to make it interesting and fun for them to run their business. We try to have a compensation arrangement that's appropriate for the kind of business they're in. We have no company-wide compensation plan. We wouldn't dream of having some compensation expert or consultant come in and screw it up. We try to. Some businesses require a lot of capital that we're in. Some require no capital. Some are easy businesses where good profit margins are a cinch to come by, but we're really paying for the extra beyond that. Some are very tough businesses to make money in. And it would be crazy to have some huge framework that we tried to place everybody in that where one size would fit all. People generally are compensated relating in some manner that relates to how their business does, as opposed to, there's no reason to pay anybody based on how Berkshire does, because no one has responsibility for Berkshire except for Charlie and me. And we try to make them responsible for their own units, compensated based on how those units do. We try to understand the businesses they're in, so we know what the difference between a good performance and a bad performance. And that's how we work with people. We've had terrific luck over the years in retaining the managers that we wanted to retain, and it's I think largely it's because, particularly, they sell us a business that to a great extent the next day they're running it just as they were the day before, and they're having as much fun running their business as I have running Berkshire. Charlie?
Well, I've got nothing to add, but I think it's that concept of treating the other fellow the way you'd like to be treated if the roles were reversed. It's so simple when you stop to think about it, but it's a rare evening when Ajit and Warren aren't talking once on the phone. It's more than a business relationship. At least it seems that way to me.
Yeah, well, it is. Stay that way, too.
And by the way, we like our relationships to be more than a business relationship.
Charlie and I are very far. We basically, it's a luxury, but it's a luxury that we should try to nurture. We get to work with people we like, and it makes life a lot simpler. It probably helps on that goal of being the oldest living American, too.
Yeah, and we tend to like people we admire.
Yeah, who do we like that we don't admire, Charlie? Start naming names. Do these people have names? Zone 2.
My name is Peter Bevelin from Sweden. How do you perceive Guinness long-term economics growth-wise?
Fitz, is that? Would you repeat that, Fitz? Was it what firm growth-wise?
Guinness.
Oh, Guinness. I'm not as much of an expert on Guinness's products as Charlie is.
We proved that.
You didn't hear him. He said I proved that. I made the decision to buy Guinness, and Guinness is down somewhat from. Actually, the price in pounds is about the same, but the pound is at about $1.46 or $1.47 against an average of $1.80 something. So we've had a significant exchange loss on that. The Guinness is, despite the name, the main product, of course, is Scotch, and that's where most of the money is made. Oh, they make good money in brewing, but distilling is the main business. And the usage of Scotch, particularly in this country, the trends have not been strong at all. But that was true when we bought it too. There's some countries around the world where it's grown, and there's certain countries where it's a huge prestige item. I mean, in certain parts of the Far East, the more you pay for Scotch, the better you think people think of you. Which I don't understand completely, but I hope it continues. But the worldwide Scotch consumption has not been anything to write home about. Guinness makes a lot of money in the business, but I don't see anything in published history that would lead you to believe that the growth prospects in terms of physical volume are high for Scotch. The Guinness itself, the beer, actually has shown pretty good growth rates in some countries, actually from a very tiny base in the U.S. as well. But they will have to do well in distilling, or that will govern the outcome of the Guinness. I think Guinness is well run, and it's a very important company in that business, but I wouldn't count on a lot of physical growth. Charlie, any consumer insights?
No.
Zone 3?
Mr. Buffett, my name is Arthur Collius from Canton, Massachusetts, and I'd like to know how you respond to the question that my associates asked me when they say that Berkshire Hathaway has been a good investment up to now, but if, God forbid, something happens to Mr. Warren Buffett.
Well, I'm glad you didn't say Charlie Munger. No, Berkshire will do just fine. We've got a wonderful group of businesses. I've told you the two things I do in life, and in terms of the managers we have, you'd have to come in and really want to mess it up, I would think. And we don't have anybody like that in terms of succession plans at Berkshire. And then there's the question of allocation of capital, and you could do worse than just adding it to some of the positions that we already had. The ownership is, if I die tonight, the ownership structure does not change. So you've got the same large block of stock that has every interest in having good successor management as I would. I mean, there would be no greater interest, and it's not a complicated business. I mean, you ought to worry more about, if you own Microsoft, about Bill Gates, I think, or something of the sort. But this place is, we've got a group down here that are running these. You didn't see me out at Borsheim selling any jewelry the other day. I mean, that's somebody else's job. So it's not very complicated. Incidentally, I think I'm in pretty good health. I mean, this stuff will do wonders for you if you'll just try it. Charlie, do you want to add anything?
Yeah, I think the prospects of Berkshire would be diminished, obviously diminished, if Warren were to drop off tomorrow morning. But it would still be one hell of a company, and I think it would still do quite well. I used to do legal work when I was young for Charlie Skouras. I heard him once say, my business, which was movie theaters like this one, was off 25% last year, and last year was off 25% from the year before, and that was off 25% from the year before. And then he pounded the table and he'd say, but it's still one hell of a business.
It's not a formula we want to test,
No.
It is one hell of a business, though, we've got here. I mean, if you saw what happened at Berkshire headquarters, you would not worry as much. There's very little going on there that contributes to things. We're right now at our peak of activity. This is it. Zone 4.
First of all, my name is Al Martin, and my wife, Terry, is here with me. And I appreciate the invitation to attend this meeting. I was a little bit dubious and quite excited at that game Saturday night. I didn't know which side was going to throw the game to the other one, but I did find out at the end. The first question actually was somewhat answered, but not fully. Has the board considered a reverse split? My experience has been that...
Would you like to make that a motion? There was a motion for a reverse split.
I would say a 2-for-1, because if it were 3 or 4-for-1, I might end up with no shares, or fractional shares. But anyway, my experience has been that all of the stocks that have split have gone down in the next 2 or 3 months or the next 2 or 3 years, including one which you are drinking, which is a flat Coke. Also, I have observed Merck over the last several years to be hitting a low, which split 3-for-1. So I think that, the reasons for splitting stocks are to make it affordable. I found that every stock I ever bought was never affordable. I found the reason I bought it was because I couldn't afford not to buy it. So that's a different philosophy. I guess that's somewhat shared indirectly with the board's running of the stock. The second question, which is has to do with...
I hope it's as easy as the first question.
Well, I didn't want to wait for an answer to the first question for that reason, because it could be complicated and confusing and so forth. The second question has to do with could the board consider looking into a commodity broker or a lawyer or both that could take action similar to Hillary Clinton's? I think, making your net worth go up by a factor of 5 overnight is more than enticing. Some of us might even want to wait for 10 months to get 100-to-1 return on the money.
Well, I want to say 530% in one day. Charlie has never done that for us. I mean, it really caused me to reassess succession plans at Berkshire. And Hillary may be free in a few years. I hope you're applauding over her coming to Berkshire, not being free, but I'll leave that up there. Okay, that was their second question. Huh?
That was my second question. Of course, in my experience, it's been that most of us have thought through this situation, and I guess it's pretty speculative, but I found out that the rules and laws that are made for trading are interpreted rather than enforced, and I think that applied to this particular case. So let's go on to the third question.
All right. They're getting easier.
This one is real easy. My wife was a collector of blue chip stamps for many, many years, and she bought some stamps with her. What should she do with them?
Well, we can give you a definitive answer to that. Charlie and I entered this trading stamp business to apply our wizardry to it in, 1969 or so, Charlie?
Yes.
We were doing what then, about 110 million?
No, it went up to 120.
Okay, and then we arrived on the scene, and we're going to do what, about 400,000 this year?
Yes.
Yeah. That shows you what can be done when your management gets active.
We have presided over a decline of 99.5%.
Yeah. But we're waiting for a bounce. And I would say this. The trading stamp business, as those of you who followed it all know, it only works because of the float. I mean, a very, very high percentage of the stamps in the 60s were cashed in. We have some years that we've gotten up to 99%, I believe, we sampled the returns because they were given out in such quantity. But our advice to anyone who has stamps is to save them because they're going to be collector's items, and besides, if you bring them to us, we have to give you merchandise for them. So tell her to keep them. They'll do nothing but gain in value over years. Going back, incidentally, to point on the split, I think most people think that the stock would sell for more money split. We wouldn't necessarily think that was advisable in the first place, but in the second place, we don't think it would necessarily be true over a period of time. We think our stock is more likely to be rationally priced over time following the present policies than if we were to split it in some major way. And we don't think the average price would necessarily be higher. We think that the volatility would probably be somewhat greater. And we see no way that volatility helps our shareholders as a group. Zone 5.
I am Peg Gallagher from Omaha. Mr. Buffett, are you interested in influencing Mr. Greenspan at the Fed to stop raising interest rates?
Well, I wouldn't have any influence with him. He was on the board of Cap City some years ago, and I know him a bit. But I don't think anyone would have any influence with Mr. Greenspan on that point. But I generally think that his actions have been quite sound during his period as Fed chief. I mean, it's part of the job of the Fed, as Mr. Martin said many years ago, is to take away the punch bowl at the party occasionally. And that's a very difficult policy to quantify, working with markets day by day. And of course, it's always been the job of the Fed basically to lean against the wind, which of course means if the wind changes, you fall flat on your face. But that's another question. But I think what he has done has probably been somewhat appropriate. I think he's probably been surprised a little bit as to what has happened with long-term rates as he's nudged up short-term rates. I think he was hoping that, this is just a guess on my part, that action sort of early in the cycle on the short-term rate front might make people feel more confident about the longer-term rates, and therefore that the yield curve would flatten some. I don't know that. And he may have been a little surprised on that. But it's not an easy job he has, so I would not second guess him myself. Charlie, how do you feel about him?
Fine.
Good. Greenspan is safe. Zone 6.
Mr. Buffett, I'm Lee Miller from St. Louis. There was an article in the April 18th Barron's that attempted to calculate the value behind each Berkshire Hathaway share. I'm sure you have some views on that, and I'd be very interested in your perspective on that issue.
Yeah, there was an article about a week or so ago in Barron's. The same fellow wrote an article about 4 years ago, reaching pretty much the same conclusion, and I hope he hasn't been short in between. But I would say this: it is not the way I would calculate the intrinsic value of Berkshire. But everyone in securities markets makes choices on that. Every day, somebody sells a few shares of Berkshire, and someone buys, and they are probably coming to differing opinions about valuation. I would say that I found it strange that apparently he forgot we were in the insurance business, but that's not total. It really doesn't make any difference. I mean, we don't pay any attention to what people say about Coca-Cola stock or Gillette stock or any of those things. I mean, on any given day, 2 million shares of Coca-Cola may trade. That's a lot of people selling, a lot of people buying it. If you talk to one person, you'd hear one thing, and talk to another. You really should not make decisions in securities based on what other people think. If you're doing that, you should think about doing something else, because a public opinion poll will not get you rich in Wall Street. So you really want to stick with businesses that you feel you can somehow evaluate yourself. And Charlie and I, we don't read anything about what the economy is going to do, or the market's going to do, or what anytime I see some article that says, these analysts say this or that about some business, it doesn't mean anything to us. You cannot get rich with a weather vane. Zone 7.
I'm Edward Barr from Lexington, Kentucky, and I'd like to ask, given the amount of capital in the banking industry, do you think that more banks should be buying back significant amounts of their stock, like SunTrust, versus just the token amounts that they're buying back, or just the authorized amounts? And then also, related question in banking, are banks too focused on goodwill amortization when declining to buy other banks for cash, thereby using purchase accounting, versus the normal practice in the industry of pooling accounting, even when the stock that they issue may be depressed or undervalued?
Well, the first question about the capital in the industry, that you really have to look at that on a bank-by-bank basis, and there is a lot more repurchasing of shares by banks taking place. You mentioned SunTrust, but National City they bought it back, I think 5% of National City of Cleveland bought back 5% of their stock in the first quarter. There's much more repurchasing going on, and that's simply a judgment call by management that as to the level of capital they need going forward, and what level of capital enables them to earn the return on equity that they think appropriate, and what they feel like paying for their own shares. So I think you have to look at that on case by case. We certainly like it. If we were to own a bank, we would, or own shares in a bank, we would like the idea of the bank repurchasing its stock at a price that we thought was attractive. We would think that they probably knew more about their own bank than some other bank they were going to buy, and that if the numbers are right, it's an attractive way to use capital. Your second question about goodwill amortization and purchase accounting versus pooling, we care not. At Berkshire, it absolutely makes no difference to us what accounting treatment we get on something. We are interested in the economics of a transaction. Some banks, some businesses generally, most businesses perhaps, prefer pooling because they don't like to take a goodwill amortization charge. We think our shareholders are smart enough, particularly if we make it clear to them the accounting consequences. We think they're smart enough to look through to the economic reality of what Berkshire's businesses are all about. And I think that some managements sell short their own ownership group by doing various kinds of financial acrobatics in order to have the charges come in a certain way, rather than, as you point out, often they might be better off buying for cash rather than their own stock as currency, but they may prefer to use their own stock because they avoid goodwill charges. we've written a few things on goodwill in the past, in past annual reports that might get to that subject. We don't care what accounting. We sort of rewrite the accounting for any business that we're looking at, because in our heads we want to have, in effect, a standardized way of looking at businesses. And if one company goes through pooling transactions and another goes through purchase transactions, we're going to recast them in our own mind so that there's comparability. Charlie?
Yeah, the published accounting results are in accordance with standard convention, and they're a place to start economic analysis. The figures are frequently quite silly on a functional basis. I'm not criticizing accounting conventions, except for some.
Yeah.
But I think it's just a place to start thinking about economic reality. By their nature, they can't tie perfectly. They can't even tie very well to economic reality.
We regard it as a negative when we find a management that's preoccupied with accounting considerations, but we find it so frequent that we can't afford to use it as a total exclusionary factor. It really surprises me how many managements focus on accounting and the time they spend on it. It's really unproductive. If you find a management that doesn't care about the accounting but does explain to you in clear terms what's going on, I think you should regard that as a plus in owning a security. Zone 1.
Mr. Buffett, my name is Bill Ackman. I'm from New York City, and my question relates to the appeal of Salomon Brothers as an investment. You talked earlier about leverage and the dangers of leverage. Salomon is a business which is levered 30 to 1, which has very narrow margins and earns a relatively modest return on equity in light of the amount of leverage that they use. What is the appeal of the business to you?
We have here today the chief executive of Salomon Inc., the parent company, and also the chief executive of Salomon Brothers, the investment banking arm. And I would say one of the things Charlie and I feel extraordinarily good about are the two fellows that are running that operation. They did an exceptional job under extraordinarily difficult circumstances, as did John McFarlane, who's also here today. The three of them, I mentioned 4 people in the annual report, and Salomon wouldn't be here today without those three, and it wouldn't be the company in the future that it's going to be without them. And they did an absolutely fabulous job. It's the sort of business that, as you point out, uses a lot of leverage. It doesn't, in one way, it doesn't use as much as it looks like, and another way, it uses even more than it looks like. But the test will be, A, whether they control that business in a way that leverage does not prove dangerous, and secondly, what kind of returns on equity they earn while using it. You certainly should expect to earn somewhat higher returns on equity when you are necessarily exposed to a small amount of systemic risk and significant amounts of borrowed money than you would in a business that's an extremely plain vanilla business. But I don't know whether you've met Bob and Derek, but I think you'd feel better about having leverage in their hands than about any other hands you can imagine. Charlie?
Why don't we have those 3 gentlemen stand up?
Yeah, you ought to give them a hand.
They really have done a job for Berkshire in this last year.
I'll lead the applause for them. Where are they? There they are. I've mentioned this before, but it's worth mentioning again. Derek took on the job of being the operating head of Salomon Brothers on August 18th, 1991. He couldn't know what he was getting into exactly. 2 months later or 3 months later, we never had a conversation about compensation. He did not ask me for Berkshire or my guarantee for indemnification because he was walking into unknown legal problems we didn't know we would finally uncover. And he worked